You saw something, Paul. Is there more to come?
Wow, that's the $64,000 question. What I would tell you is I think it would be foolhardy to buy this dip because we don't know what's going to come as a follow-on the next couple of days. But there's some tech stocks that have now been smashed, and I like to invest in tech with the Buffett philosophy of be greedy when others are fearful. And there are some opportunities that if you can look me in the eye, straight in the eye, and say, yes, I do not worry what's going to happen to that stock between now and the next couple of weeks or months, but a year from now I do. There are some stocks that I would very aggressively recommend investors get in if they have the proper 1 to 2 year perspective.
So, Michael, given the uncertainty around the trade war, how do you see tech performing relative to the rest of the market? Are there tech-specific things going on here that the broader market won't be, won't succumb to, if you will?
Well, I think, when Luke was just discussing this sell-off in tech shares and how that's kind of leading the way down here, I think you have to dig in a little bit and bifurcate it. So there's certain subsectors, semis or Apple, for instance, that will have fundamental issues, challenges if trade tensions continue to escalate. But I think you also have to look at, tech, the tech sector, the NDX index, that has led the way up, right? And so part of this broader de-risking you're seeing across assets, right? The bond bid, the gold bid, and the Swiss franc bid, as you were just discussing, right? Well, what went up the most, what gained gained the most this year is going to be selling off a lot. So I think you have to really disaggregate, what's fundamental and what is de-risking there. Fundamental as it relates to this, potential damage from escalating trade tensions.
So, Paul, let's take a company like Apple, for example. In the short versus the long term, what's the approach?
Apple, I've given it a full valuation and then some for the services business that everybody seems to be so enamored with. And I value Apple about $170 to $180 a share. I own it because it's in my benchmark and it is a big player. However, going forward, I don't have the same uber bullish view on Apple as others do. I have other ideas, even if you want to play services and software, that I think are superior to Apple.
Meantime, it wasn't all bad news. Some tech stocks that ended in the green: Lyft, Roku, Slack, Pinterest. Michael, where should we be looking for good news?
Well, look, I mean, I think when you, again, to this concept of bifurcating, what is sort of beta being, risk managed down, and what is being fundamentally damaged by escalating trade tensions. There's stocks like Google there, which haven't had a massive valuation, are not at the valuation that we've seen in the past, and probably, arguably, don't have quite as much exposure to some of the trade tensions that some of the other tech stocks do. So there are a lot of pockets there, but I think you really have to look at, when you're thinking about portfolio management, you have to think of, look, if this risk off is going to continue, you're going to see the XLK and the Qs sell off, continue to lead the way down. I would point out that just on a year-to-date basis, the NDX is still up 300 basis points above the SPX, which are, 2 weeks ago when we were, cruising into fresh highs, it was the same 300 to 400 basis points ahead there. But again, I think your other guest is right. Given that we don't know the Chinese reaction function, given we don't know the efficacy of incremental monetary stimulus coming out of this, I think there's no reason why you have to jump in and buy this particular dip right now.